Hey my little people, I was scrolling on TikTok watching videos as I normally do, and I stumbled on something that one of my favorite YouTubers, Khalil Reynolds, posted. And basically it was just showing bank interest rate on savings account, and they were somewhere in the 10 to 15% region. And people are in the comments saying, why can't we get back these rates now? Well, that video didn't necessarily portray the full truth, because back then when persons were getting 10 to 15% on savings account, the other half of the story would be whenever someone would go out to take a loan, in those times the interest rate on those loans would be in the 20% brackets or even higher. So I think understanding how a bank loaning system works will give you a better understanding and to understand how banks make money. We as depositors go to the bank and deposit money in our savings account. Your money doesn't necessarily just sit there in the bank. The bank uses your deposited money to make more money. So what happens is that the bank lends out your money along with other depositors like yourself, and then lends out that money to other persons and corporations, and then charge them an interest rate on the loan. So let's say, for argument's sake, the bank gives you 1% interest on your deposit. What they'll do is then they'll create loans with the deposit and lend out your money at say 5%. The difference between the 1 and the 5%, which is 4, is called the interest rate spread, which is basically the bank's profit within that transaction. And this is why when persons who have millions in the bank, when they come to withdraw a sudden million, the banks will say you can't withdraw the amount one time because them not have the money. It's in loans. However, the Bank of Jamaica set a reserve on how much liquidity a bank must have in order to meet regulations, and to also have some of the customers deposit if in the event they decide to come for a portion of it. The reserve requirement is 13% in international currencies and 5% in local currencies. However, if a large institution comes in and wants to borrow money, it might be a bit different. So let's say Winton Wing Farm comes to you as a bank, and let's say you're NCB and they want to borrow $2.7 billion. That's a lot of NCB client money that would be tied up in a loan. So what NCB might decide to do is to create a syndicated loan, which is a fancy word of saying just group lending. So basically what NCB would do is get the client, then create an information memo, and you would basically have in the financial analysis of the company, information about the company, its management teams, and the reason for borrowing the money, and other information. This would be created by the lead arranger, which is NCB, and then NCB would call Bank of Nova Scotia, JMB, Sagicor, First Global Bank, Victoria Mutual, Jane, and any other loading institution, and then basically ask them if they're interested in lending money to Wington. So each company that is interested in lending the loan, so let's say NCB puts up 400 million, and JMB puts up 200 million, and so on and so forth. What this does is essentially reduces the bank exposure to the risk of the loan, whilst also sharing in the loan repayment. And of course, Wigton would pay NCB a loan, and then NCB would disperse the payments based on the allocation they decided to take up. So basically at the end of the day, if banks pay a higher interest rate on savings account, then you can expect in theory that you will get a higher interest rate on money borrowed from the bank. And that's really it. I just thought it was a really cool concept that you guys might like. So as usual, smash the like button for the YouTube algorithm. Definitely subscribe and comment what other financial terms or concept you'd like to know about. So love you guys. See you Monday.